Software multiples are down 60% since 2021. There is a fundamental repricing of SaaS companies that's happening right now. In this video, we're going to break down the software stock valuation data you haven't seen elsewhere, why profitability suddenly matters more than revenue growth, which software categories are getting hit hardest, the Goldman Sachs warning, and one investment strategy investors are considering right now. Let's start at the end. Software valuations are going down. This table is based on the holdings of the iShares Expanded Tech Software Sector ETF. It also includes the Magnificent Seven. Over the last 5 years, this group of software stocks, excluding the Mag 7, are up only 11%. That's 11% over 5 years. They are down about 19% in the last year and down about 23% since the peak around September, October of 2025. Here's what's interesting. This is happening despite revenue growth. Valuation change has just overpowered the business gains. For example, Salesforce. Salesforce increased its revenue from $21 billion in 2021 to $40 billion in the last 12 months, and the stock has declined over 5 years. This disconnect is striking. Adobe, HubSpot, same pattern. Revenue up, stock price down. And not just recently. Again, it's over a 5-year period. Now let's talk about the broader market. Software Equity Group publishes an annual SaaS report covering both public and private companies. The median market cap was about $5 billion. This table shows median metrics for their SaaS index. Enterprise value to trailing 12 months revenue, basically what investors are willing to pay for each dollar of recent sales. Those multiples dropped from 13.5 times in 2021 to about 5.3 times in 2025. That is a 60% decline in the multiple. Here's the twist. Net income margins and cash flow margins increased. SaaS companies are running better businesses, more profitable, generating more cash, and valuations have collapsed. Despite strong business performance, the headwind of valuation has just been too strong. I think the change in profitability is the most important data point here. There are reasons why I think we might be seeing a shift in how SaaS businesses are considered by the market, but we'll come back to this point later. Now, some nuances with these numbers. First, it's the Mag 7 versus everyone. In both of these two different data sets, the iShares Index and the SCHD Index, the Magnificent 7 drove the gains in software. In the SCHD report, they noted that NVIDIA and Alphabet alone accounted for more than a quarter of total market gains in 2025. If you didn't own the Mag 7, you basically missed a software bull run. Second, not all software categories are getting hit equally. Certain product categories have been winners, while others are taking the brunt of the decline. Analytics and data management has seen modest improvement. Communications and collaboration is basically flat despite earnings growth. Pretty much every other category, DevOps, IT management, ERP and supply chain, financial applications, human capital management, sales and marketing, all have seen sharp reductions in the multiples. And remember, this is with revenue and profitability growing. What I take from this data is that investors are just not willing to pay the same level for these businesses. This is a shift which is likely permanent. Why is it permanent? Let's break it down. Everyone loves to blame artificial intelligence for decline, but there's more to the story here. Over the last 20 years, most companies have already digitally transformed. Markets are saturated. Customers have already plugged in. Financially, CFOs are demanding stronger returns. Budgets are tight. Incremental budget, if any, is going towards AI adoption first. Operationally, CIOs and purchasing managers are looking to consolidate vendors. A report from BetterCloud in 2025 states that the average number of SaaS applications per company declined 18% in the last 2 years, from 130 to 106. This decline is happening across most organization sizes. This product consolidation, which is already happening, likely accelerates during the AI transition. It's much easier to have one multi-tool than 10 different applications. The pricing model is changing too. The business is moving from seat-based pricing, which scales with employees, to value or hybrid-based pricing, which demands higher quality outcomes. This puts pressure on software companies to connect product results directly to business outcomes. Another big problem, if AI integration allows one person to do the work of 5 people, your customer no longer needs 5 licenses from you. Even if you raise the price per seat, there are limits to how much customers are willing to pay if they need fewer seats. This raises the importance of a key metric, net revenue retention. Net revenue retention measures revenue from a specific group of customers over a certain period of time. For example, let's say you have 100 customers that generates $1 million in revenue, and then next year, the same group of customers shrinks to 90 customers. Some customers cancel, but now you generate $1.1 million in revenue. This would be a 110% net revenue retention. This chart from Bain and companies shows net revenue retention progression in the sector. Investors watch NRR because it demonstrates the company's ability to grow from its existing customer base, consider things like cancellations, upselling, and pricing changes. Companies with higher NRR get higher valuation ratios. At the same time, revenue growth rates have been declining. Companies are still growing, but they're growing at a slower rate. Slower growth, lower multiple. A recent Forbes article said this about the decline in software stocks. Markets do not erase that much value unless a core assumption breaks. The assumption that just broke was the durability of legacy SaaS growth. Okay, so let's summarize. Artificial intelligence is a technological disruption. CFOs want stronger returns. Budgets are tight. New budget goes to AI first. CIOs want fewer vendors. Pricing models are changing. More emphasis on products proving value, and revenue growth rates are falling. Which raises a question. Is it software valuations that are changing, or is it the way software companies are valued that is changing? I think it might be the latter. Remember that profitability data I mentioned? Here's why it matters. I think we're seeing a fundamental shift in how software companies are valued. It feels like there's much more intense focus on profitability now, not just revenue growth. AI is the new growth stories. SaaS companies are not. It means that they're getting evaluated as regular businesses. Profitability, operational execution, competitiveness, revenue growth. The SCHD report notes the following. Premium valuations in 2025 remain firmly tied to growth, as profitability has largely become table stakes across the public SaaS market. Companies throughout the SCHD SaaS index are now broadly profitable, including those in the lower quotile. Growth still commands a premium, like it does for most businesses, but software companies can no longer rely on revenue growth alone fueling valuation. They need to have profits or investors leave. Here's another quote from Forbes. When profit pool move faster than revenue disappears, public markets react immediately. Bain and Company puts it this way. In the past, a great product in a growing market could compensate for weakly managed operations because customer adoption kept rising anyways. That's no longer true. Software companies now need to run their core business extremely well with better cost control, strong execution, high productivity, just to stay competitive. At some point, every technology becomes old technology. Growth slows, margins compress, investors demand profits. SaaS has not fully transitioned to this state yet, but this feels like the early stages and will continue to accelerate going forward. Now, there are some software categories that might actually benefit from AI adoption. Recent research shows certain areas are seeing increased demand. Data integration and ETL tools are projected to grow from $6.7 billion in revenue in 2023 to over $20 billion by 2032, a 13% compound growth rate according to Global Market Insights. Why? Because AI creates ever more data complexity. Organizations using AI across multiple functions generate massive amounts of data from different sources that need to be integrated, managed, and made accessible and usable. That complexity drives demand for higher integration applications. McKinsey 2025 State of AI report found that 78% of organizations were using AI in at least one business function, and that 71% were using generative AI. The companies that help businesses manage, integrate, and extract value from AI-generated data and insights may find themselves in a stronger position than those competing directly with AI capabilities. This doesn't mean that they're automatically safe bets. It's just that not all software are facing the exact same headwinds. Here's one thing that I'm not worried about when it comes to AI disrupting software. I am not worried about the idea that the average person will create their own software so seamlessly that SaaS companies disappear. I think it's overdone and way too early. Just because people have the ability to create software doesn't mean everyone will be creating software. Most people have a kitchen, but restaurants still exist. Making a good product requires skill. Cost and time is a factor as well. And a certain level of security and sophistication is required, particularly at the enterprise level. There are regulations like CCPA and GDPR that require compliance. Data security and integrity are required discussions points for customers. You can't just slap together a piece of software and expect customers to buy it, no questions asked. It's not going to happen. Now, I do believe that there will be much more software created. That seems almost certain. And maybe once artificial intelligence is advanced enough, people will simply be able to define the outcome they want, and the AI builds whatever capability it needs. But that's not here yet. It's not a near-term risk. Look what happened in the media business. Content creation and distribution became essentially free. Volume exploded. Amazing creators who previously could not break through into media now can. But there's also a lot of low quality content. I think there's a very clear example in design software. Here's three products: Adobe, Canva, and Photopea. Adobe is the high-end enterprise solution. Revenue keeps climbing. Canva made design accessible for average people and built a massive business. Photopea is high-quality design software in a browser completely for free. All three platforms serve the same important function: digital design. They occupy every price point: enterprise, mass market, and free. All three are thriving. AI is a little bit different. SaaS is only a tool. AI is different because it can be both a tool and a tool builder. Cost structure is different as well. AI runs on tokens and every interaction costs money. If someone uses Canva, they pay $10-20 a month for unlimited use. That's not the same way with AI. There are going to be many unpredictable outcomes. If investors can't forecast where the profits are going to be, they can invest somewhere else. Remember, investing has no called strikes. You don't have to do something. Okay, if investors want less software exposure, where can they position themselves? In times of uncertainty, value stocks can provide stability. SCHD and VTV are examples of things investors can look at. The PE ratio for SCHD right now is about 18 to 19 times earnings. and the portfolio is not oriented towards technology stocks. VTV shows a PE ratio of about 21 times. By way of contrast, the PE ratio for VOO is about 28 times earnings and 33 times earnings for QQQ. For a single dollar of earnings, you're paying 50 to 100% more for growth stocks versus value stocks. Growth is important, but so is valuation. Investors need to consider both. Now, if value stocks does not sound like an exciting idea for you, well, that's kind of the point. When you're looking for stability, excitement is not what you need. These are just two examples among many. There's lots of other value stocks, lots of other value ETFs. Value stocks have their own risks. They can underperform during strong bull markets, just like SCHD did before its recent run. This isn't a recommendation that value is the right model move for everyone, but something to consider. Timing market rotations is notoriously difficult, but investors who can position themselves ahead of capital flows rather than chasing performance, making a benefit from rotation. And right now, it appears to be that investors are rotating into value stocks. So in conclusion, the market is repricing software companies. Contrary to the headline narrative, this repricing has actually been happening over the last 5 years. Goldman Sachs compares the current situation in software to what happened with newspapers. The news still exists. Journalists adapted. Many outlets even use the technology that disrupted them. Product is still here, arguably more efficient than before. But the businesses are worth dramatically less. As Goldman Sachs eloquently puts it, share price stability requires stability in the earnings outlook. Everyone believes AI is the future. Everyone believes it's revolutionary and will only improve. Everyone believes software companies will use AI. But until there's more certainty around expected software profits, investors should expect more downside volatility according to Goldman Sachs. Revenue and profitability are both in focus. I think that's the most telling of all when it comes to valuations. Artificial intelligence now holds the growth mantle. Software investors are doing nothing more outrageous than looking at SaaS and software businesses like every other business. And when that happens, valuations are likely to follow. Since the peak in 2000, newspaper revenues have fallen 80%, even with the pickup in digital advertising revenue, according to a Congressional report. Stock price for major newspaper companies declined by an average of 95% from 2002 to 2009. This is the pattern of industry facing disruption. Revenue peaks, it takes a few years for investors to start seeing the impacts, then stock prices decline in line with earnings estimates, which come before the true business bottom in results. I'm not predicting software falls that exact same path. It's about understanding that technological disruption, repricing can take years to fully play out. How long will the software repricing take? Nobody really knows. But understanding the forces at work will help investors make informed decisions rather than reactive ones. And clearly, over the last 5 years, it's already been happening. The investors who accept this shift early enough will have time to position themselves accordingly. The ones who wait will be repositioning into strong prices after the rotation into other stocks is already underway. That's it. Hi, I'm Charles. I don't like most investing and finance content I see online. It tends to try and sell you something. You don't need to buy anything from me. This content is for entertainment purposes only. Seek professional advice for your situation. I want to make financial freedom accessible to the average person. Profit is desirable, ownership is freedom. Good luck and goodbye.